Yo, what's up, stock bros? Good morning. It was a good morning for me. I was trading GameStop, and I had previously purchased at $89, and then this morning actually I sold it at exactly $100. So I'll just show you guys how tight that was. As soon as the market opened, basically Wealthsimple is the platform that I'm using to do all my trades. I'm not allowed to do any pre-market and post-market. I used to do a little bit, and it's where most of the action happens, but today turned out to be my favorite. So I had an order set to sell it at $100, and this is what happened. So just expanding here my chart. So this is 6:30. This is 6:31. So exactly at 6:31, the market price for GME went from started at 95.81, went as high as 101.56, and my sell point was exactly at 100. So look how tight that was. I sold my GME shares exactly at one of the highest points, and then obviously on that minute it closed at about 93.7. So it's a good morning nonetheless. It's pretty much of a hype stock, but nothing saying that we can't jump and benefit from it. So the purpose of this video today, I just wanted to give a brief intro in regards to taxes. And just to clarify, I do use Thinkorswim for my technical analysis, but all my executions happen exactly at Wealthsimple. So I'll just use Wealthsimple's account types as the example. So this is for the Canadian side. I'm not going to get into the US side right now, as I need to do a lot more research. But here it is. Canada side, you have three primary ways of investing in the stock market. You have a personal account, which is a non-registered account. Then you have RSPs and tax-free savings. So TFSA. So both of the bottom ones, RSPs and tax-free savings, these are tax sheltered in some way, shape, or form. To keep things simple, I'll just move along. I have Nick making a video for specifically on tax-free savings, which we'll be able to elaborate a lot more, quite in depth. We can get straight like to the depths of it. Same thing with RSP. We'll make another one, but this is just an introduction so everybody's somewhat clear on how everything works. So if you have a personal account, which is a non-registered, you have to pay 50% taxes on your capital gains. So if you invested $1,000 in the year, and at the end of that year you were to have made another 1,000, so you were to finish the year with $2,000, you would take whatever profit you had, which would be in this case 1,000, divided by 50, and in that lump sum, so in this case $500, that's the amount that you're paying taxes on at whatever bracket you are. So it's very good to make money in the stock market because you're not charged taxes at 100% of your gains, only 50%. Only 50%, which is great. And same thing applies in reverse. What if you were to lose money? Whatever money that you would lose would be subtracted from your yearly salaries or whatever ways we make money, and that could come into our benefits. Obviously, we will still be coming out at a loss because we lost money in the year, but it can play to some of our advantages. Capital loss, then it would be called. So quickly moving on, then we have RSPs, which the whole purpose of RSPs is you bypass taxes on the current year that you're in. So if you were to put money into your RSPs at this year, whatever money that you'd put from your account to RSPs would be deducted from your tax year end to reduce basically how much the CRA would look at you in regards to how much you made that year. So again, that would play into benefits. And the good thing about RSPs is if you're making tons of money, that's the time that you should be putting into RSPs. But when you do remove from your RSPs, you will have to pay taxes. So the best scenario is well, what it's intended for, retirement. You put into RSPs as much as you can during your working years, and when you retire, that's when you pull out, which means that your tax bracket will be the absolute lowest. I'll explain my reasons later, but I'm not the biggest fan of investing on RSPs just because it's such a long term ahead for me to fully gain all of its benefits. So, moving on to my absolute favorite, tax-free savings account. So, tax-free savings account is, I'm not gonna get into too much depth, but enough for this video to make sense. So, this is how it works. Tax-free savings account. Whatever money you put it inside there, which we do have limits here in Canada. Most years it went up about $5,500. There was like a couple odd years that it went up $10,000 and so forth. But anyway, I think everybody's limit is somewhat similar. Basically, it starts to count as soon as you're 18 and a Canadian resident. Actually, I think it's a Canadian citizen. Anyway, I'll look into this. But tax-free savings account, whatever money you put in there. So let's just say you were to, hey, I'm gonna put $1,000 in there. You have already paid taxes on that money. So probably the previous year you would have already paid whatever tax bracket you are into this. So the money that you put in tax-free savings has already been taxed. Keeping in mind that you have a limit up to, and I think my limit now, and I think most people's limits, is about $80,000 or $70,000. So there's a lot of room. You don't want to exceed that because there's a lot of taxes and penalties if you do so, because tax-free savings is a phenomenal tool. So what if you were to make money inside there? So if you were to invest $1,000 inside your tax-free savings and you were to make another $1,000 during the year, how much would you pay in taxes? What's absolutely zero. Whatever income you make inside tax-free savings, it is exempt. That's as simple as that. Now, on the video that Nick will do, we'll get into a lot more depth in regards to there are some criteria that are exempt from tax-free savings, and it has to do with the amount of time that we hold stocks. Again, we're just talking simply about stocks, but for a very simple portfolio, somebody that just holding for a few days here and there, a short-term swing trader, whatever you make inside there, it is absolutely tax-free. And I have to emphasize, our biggest expense while we are alive will be taxes. And so if we can bypass as much as possible, it only comes to our benefit. It's huge. So personally, I trade on a tax-free savings account, and I recommend everybody from Canada to do so. Just simply, if I don't have to pay taxes, I won't pay taxes. And this is a 100% legal system that the Canadian government has set, so that investors can make money and not have to pay taxes. Tax-free savings account. So anyway, I hope you guys enjoyed this super intro in regards to taxes in Canada. I hope you make your wise decision in regards to which account you want to trade under. And yes, this is just an intro, so sorry if I missed a lot of stuff. But anyway, hope you guys have a good morning, and yeah, let's not forget to drink water. Water is super good, makes our minds clear so that we can make phenomenal trades. See you guys.